Good day, fellow investors. This was a great comment on an old video of mine about how investing in dividends allows for compounding over the long term. And when the market does nothing for 15 years, as it is priced for doing now, then you might want to change your investment strategy into something that works no matter what. We recently discussed stocks at all-time highs but fundamentals deteriorating. You might want to watch that video. I'll put all the links to videos in the description below. But when you look at the current Shiller price-earnings ratio, we are at the second historical high, and given the data we have shown in this video, the returns when the Shiller ratio is high, the returns over the next 15 years will be low. You will not double your money in the next 10 to 15 years, which is a very low return. And when you compare historical returns, 29, 99, 1965, to the stock market returns, you can see here 25 years of flat, 17 years of flat, 12 years of flat, and then we had money printing. But if there is no money printing, then the 1.27% dividend yield will not help you much. So how to invest now if the market is flat for the next 20 years, but also if it isn't flat? We try to invest in a way that no matter what happens, we do well. Because these cycles are normal for the stock market. You always have to expect ups and downs, and I think nobody expects 20 years of nothing, but that has happened many times in the past and will happen again. And then when it comes to the question how to invest, dividends, cash flows, compounding no matter what, that's Warren Buffett's secret. And you will say, Sven, that's boring. Well, here is the answer. Yes, getting rich slowly means getting rich surely. So I want to compound my wealth over time, not take risks that block that compounding, and I want to know that in 10-20 years I will be well off. All these S&P 500 stocks only go up, yes, until those don't. Because if you look here, stocks don't go up for 20, 17, 12 years, 22 years, and all is left is the dividend, and we already mentioned there is no dividend at the moment. So let's apply this strategy of investing that we do well no matter what, even if the market is flat for 20 years. Warren Buffett's strategy number one, he is heavily invested into 3-month US Treasuries, getting 5.37% from the US government. If you look at his cash position from his last statement, then he has almost 200 billion of cash, just getting 5%, and he is happy. And perhaps even more important, that's just shy of 20% of the whole assets of the Berkshire conglomerate. Given the things there hold forever, we could say that for a normal portfolio, if you say you have a house and something like that, 50% of liquid, I would say, assets is in cash getting 5%. That's boring, yes, that's Buffett, and that is why he has been investing for the last 70 years doing well. Retained earnings 600 billion, thus a third of retained earnings of all the earnings that Berkshire made in history is in cash. Investing 5% slow and steady. Warren Buffett understands those cycles, and he's willing to miss out on the S&P 500 for the last 10 years, doubling and more, because he knows that when the cycle reverts, he wants Berkshire to be buying, investing at lower prices. That is investing. And I want to show you something here. You can Google this stock market charts that you never saw. I'll put the link also in the description below. And we have here a great analysis of charts that you have never saw. This one is the standard chart. Sven, stocks just go up, just put your money in the S&P 500 and forget about everything else, right? However, From the same chart, if we adjust a little bit, July 1952 to July 1982, that's a long period of almost nothing. 64 to 1994, real returns of course. That's again 30 years of absolutely nothing. Imagine stocks always go up, people heading into this for the next 30 years, and heading into this is what the fundamentals are projecting. Most likely, anything can happen, but most likely. And here you have the explanation of why Warren Buffett is investing in bonds. Because there are some underperformance, 22 years of underperformance of stocks compared to bonds. Here is, again, bonds set to equal stocks in February 1980, showing near equivalent performance over the 40-year period ending 2009. Then there are, of course, severe bond underperformance times, but at completely different valuations. At current valuations, we have already explained how it is most likely that real returns will be negative for the coming decade or even two. Another alternative to bonds is global markets. If we look at emerging markets in China, for example, the valuations there are half of the US. Half of the US. And I'll give you also some stocks. But before the stocks, yes, investing globally, knowing into what you invest takes time, takes effort. It's not easy to be a contrarian these days, but it works better over market cycles. As Warren Buffett focuses on these long-term cycles, many call him crazy, but it works over time. The focus is on dividends, owning businesses, and reinvesting those cash flows and getting your returns from the benefits that you gain from owning a business. Imagine there is no stock market. How do you get rewards? That is the key of investing. And there are some businesses that we discussed, like Amsterdam Commodities. This is also covered on my stock market research platform. You can check that for updates. Then there is FMC that we discussed recently. We discussed McDonald's, a little bit pricier, but you will likely make money, some money over the long term. We recently discussed Ambev, Brazil, with a good dividend yield. And then it is up to you. If you want to have peace of mind, you can have more treasuries. When something is cheaper, when you understand it well, then you might want to expand into something else. It's just seeing how something fits you, and I think if you like more value investing, if you don't sleep well with the S&P 500, this is the channel to be subscribed to. Thanks for watching. Check my research platform for my portfolios. I'll see you in the next video.